Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Syding. Let's conclude this deep dive into Microsoft with an assessment and discussion around the risk of an investment in Microsoft stock. We can start by concluding that assuming a 17% annual earnings per share growth, that's asking quite a lot from any company, not least from a behemoth like Microsoft, one of the absolutely biggest companies in the world. However, they have delivered that type of growth so far, and they've been growing for decades at more or less this level. So perhaps they can actually find new avenues of growth, new products, new ways of increasing prices and expanding their area of operations. So maybe they can actually grow sales by, let's say, about 12-13% per year. That's about twice the nominal GDP growth rate, even in a negative scenario. And with, if they can keep their margins, maybe even expanding them a little bit and using cash flows to buy back their shares, they should be able to perhaps reach 17% annual EPS growth over the coming 4 years. But as you can tell, it is asking a lot. So we do have a downside risk here. And as you can see, checking on what the analysts are saying currently, we can see this in Koyfin. If we look at analyst estimates overview, and we can look at sales numbers. These are the estimates for sales numbers currently, 14%, 13%, 14.5%. So we're more or less where we've been in the past. Looking at EPS growth estimates for the coming years, actually analysts are a bit less optimistic than I am. So they are talking about 12, 14, and here actually 17% earnings per share growth 3 years out, 2.5 years out. So what can we say about this? Well, analysts in Koyfin, they lend a little bit of pessimism to our 17% annual EPS growth rate projection. And maybe you could say that their estimates deduct somewhere around 10% in total EPS growth rate, and that would be a 10% reduction in total value as well, given that we use this same 4-year valuation multiple. If we need to reduce our end state valuation multiple as well by a couple of percentage points, then that will result in a total 15% lower total valuation estimate for Microsoft. And we can also say here that the 30x multiple, remember that we used a 25 to 30x multiple for PE multiple for Microsoft in 4 years, looking back at the 17% history and looking forward to maybe a 12 to 15% EPS growth rate. 30x is quite a lot to hope for, actually. Sure, they are currently at over 30x. And they have been valued at between 30 and 40 times PE for quite some time. But we might be entering a little bit of more of a cautious period. So 30x is definitely hoping for a lot, and 25x, which was the low point of our range estimate, that is probably more reasonable. And if we are looking forward to a 25x multiple and maybe just a 15% growth rate rather than 17% up until then we're actually looking at maybe 10% lower total valuation level than even our low point here of of 9.4% total return. So if we subtract about 10% over 4 years, that's about 2% per year. That would take us to about 7.4% annual return, total return. And that is definitely way too little to invest in an individual stock like Microsoft. So in summary, our range estimate here of 9 to 14%, or actually maybe we could call it 7 to 14% estimate, where 14% is definitely at the very optimistic peak of what we can expect from Microsoft. This hardly pays for the idiosyncratic risk that we are assuming when we buy a stock, an individual stock. Look at the individual estimate here, the 17% assumed growth rate. Well, it's probably too high. It could easily miss by 5 percentage points per year, and that would amount to about a 25% miss over 4 years. The 30 times future P multiple, as we said, it is also quite optimistic, could also easily be 25% lower. So let's say 22.5x. That would be about 50% above the average historic market valuation multiple of 15 forward-looking. That would be forward-looking. But as we can tell here, it's all the risks are on the downside in our estimates here. So my conclusion in this deep dive of Microsoft is that the current valuation is not impossible to sustain. They could actually keep their PE rating so that they end up with the same PE rating in 4 years' time. And if they do, that would give us as investors a total return of the dividend yield plus the actual earnings per share per year growth rate, which could be somewhere between 12 and let's say 17%. So we could actually get a decent return, let's say a 15% annual return, which is just about enough to actually warrant an investment. But that hinges on a 15% EPS annual growth rate, 14-15%, and keeping their very high price earnings ratio. So it's more or less just just about possible to reach the high end of this to get a decent return and not a good return. So in total, there are much better alternatives available. Microsoft as well as Apple, with these pretty low growth rates and very high price earnings ratios, are probably more or less 2 times as too high valued. They are 100% overvalued, I would say. That does not mean they are shorting opportunities. I'm just saying that they are not reasonable investments for a value investor who wants to have a margin of safety in their investments. I would also like to conclude by saying that hours spent researching are months saved on regret and anxiety. Actually, even just 10 minutes of investigating a company like this is worth making. It does count. Unfortunately, fortunately, I would say, is that the average investor, the median investor rather, spends about 5-6 minutes on just looking at the stock superficially before investing, and then have a very short holding period. So if you actually invest just an hour, some of you would think that these deep dives are not deep at all. They are made in like 30-40 minutes, but that would still put you leagues ahead of the median investor. And then again, you could always spend a full hour, or actually a full day, let's say 8 hours, and that would make you a really good investor compared to the average.